Canadian banks are big. Canadian banks are strong. They're stable. They provide your pension because they're in all of our pension plans. They're funding our retirement. And generally speaking, Canadians think good things about their banks. But the truth is, they're also ripping us off quite badly. Hello, welcome to the Full Comment Podcast. My name's Brian Lilly, your host, and today we're going to look at an issue that started to bubble up on the political side and speak to an author who's examined this. Might shock some of you, though, to find out that the Conservative Party is the one that lately has been taking an aim at banking fees. Several MPs have raised the issue that, quite frankly, we are being ripped off by our banks.
This is a huge issue. The federal government committed to lowering bank fees for Canadians. They have not done that.
Compared to the U.S., Canada has 34 domestic banks versus the roughly 4,844 domestic American banks.
When it comes to bank fees, Canadians pay among the highest bank fees in the world. Only 6 banks control 95% of mortgages.
Andrew Spence is someone who's worked in the banking industry. He's worked for various governments, provincial, federal, internationally over the years. And he took a look at the banking system and joins us now to talk about it because Canadians pay some of the highest fees in the world. And Andrew, I'm not exaggerating when I say, flipping through your book, I'd get furious and I'd put it away and then I'd pick it up again and I'd get furious and now I'm just angry. How badly are they ripping us off?
Well, badly is a simple answer. So, McKinsey, the big global management consultancy firm.
I walk my dog past their office here in Toronto every day.
Yeah, wrote an article earlier this year about is it springtime in Canada's fintech industry? With a question mark, because the answer is no, it's not. It is a silent spring. But in that article, they pointed out that Canada's banks have revenues about 8% of GDP. And the average for the closest countries to ours in terms of the structure of the banking system, the UK, Australia, and the US, their average is about 6%. And if you go to Europe, where the fintech revolution is in full swing, their take of revenues relative to GDP is just 4.5%. Now, why is that? That is the case because those countries take competition policy seriously and they take consumer protection seriously. Whereas in Canada, we either don't take competition policy seriously, and I'm pretty sure we don't, or we don't execute on elements of consumer protection. So the banks are able to take what they want because the competition is just not there. And that's a function as much as government economic policy and an attitude towards competition that until recently was non-existent.
You said fintech, and then I say, well, but wait, I thought our banks were highly tech savvy. Our rollout of the Interac system, our debit card system, far advanced in the United States. For years, I've been traveling to the United States with more cash than I would ever carry with me here because it's not as prevalent. Now, that gap has definitely closed over the last while, but doesn't that prove that our fintech is superior? Look at the Interac system.
Not in the least. So I walked past my bank just the other day, and I glanced through the window, and I noticed that the difference between what they'll sell me a US dollar and what they'll buy it from me is 7 cents. Think about that for a second, right? So if I was going to go on a trip to the US, I'd go into the bank and I'd say, I want to buy $1,000 US because the US system is not very good. I won't be able to take my money out of the machine. I just need to have that cash. And they'll say, sure, Mr. Spence, give me $1,470. And I say, okay.
Yeah, so they give me that sounds familiar. I'm on my way to the US, yes.
But then I realized, the trick's been canceled. So I don't need these dollars anymore. So I'd give them back to the teller and I say, can I have my money back, please? And he would give me $1,400 back. So I would pay $70 just for that momentary transaction in person, in a branch, with a person. Now, if I banked with a European bank, I'd have what's called an open banking app in my hand, my smartphone. I'd say, I want to buy $1,000 please. You put that in there. They would find you the lowest cost provider of those funds. You'd hit the button, buy. That money would be instantaneously in your bank account. Now,
without having to open a US dollar account, which is what we would have to do here, with the fee, of course.
Yeah, so let's go through the transaction, right? So let's say there are a number of fintechs here in Canada that will offer you foreign exchange services at mid-market, right? Halfway between what the bank buys and sells for. But I got to have a Canadian dollar account. I got to have a US dollar account. I got to send the Canadian dollars to the fintech provider that converts it to US dollars, and then he or she has to send that money back to my US dollar account. And I save myself $35, but it might take 2 days, 3 days potentially. And then I got to pay the Interac charge of $3, $1.50 each way, even though the cost to the bank is 12 cents for that entire transaction.
Hold on. Can you state those figures again, please?
Sure. So the bulk fees for banks to transact through Interac are 6 cents a transaction. But for you and me, Brian, to do that transaction, we're paying $1.50. So that's a huge margin over the cost of facilitating the payment. But anyway, we'll come back to that in a minute, because the key part about why you don't bother with this fintech setup as it is because I've got to pay a fee on my US dollar account that I'm holding there for the sole purpose of receiving a US dollar payment from a fintech provider, so I can save some money on the cost of transaction. When I add it all up, I'm probably paying more by getting set up to do that, because I don't make many foreign exchange transactions per year. All this by way of saying that these frictions are put in place by the fact that our payment system is archaic now compared to what you can get in Europe and even in the United States, where their take-up of digital banking is significantly higher than ours.
The answer every time that someone raises an issue, though, is something that I mentioned in the introduction, and that is stability. We have a stable banking system. We want a stable banking system. This is why we can't allow foreign competition, is because of the stable banking system. So is that a small price to pay or a very large price to pay for a stable banking system?
Canada's banking system is stable, certainly because Canadian banks are conservative relative to banking in other parts of the world. But they're also stable, and they also had a better financial crisis in 2008, 2009, because they are more closely and carefully regulated by OSFI. One of the reasons that both back then, well, especially the United States, got into so much trouble is because not only did they liberalize their system, that is, make it more competitive, they also dropped the ball on regulatory oversight by various regulators. So in Canada, we had a clear cap on how much leverage banks could pursue. We had significantly higher capital standards than the Basel II Accords, which was a sort of a globally agreed upon capital minimum. And we also, because the banks have this oligopolistic grip on their customers, and because they are allowed to assign fees to many, many different dimensions of transactions that go through the system at ever higher prices, they did not have to reach out along the risk curve to try and satisfy high expectations of returns. And so we avoided the ugly politics of bailouts, for sure, because our banks didn't go under. But I don't think people realized that Canadian banks had a significant amount of help from our authorities, especially from the Bank of Canada Finance Department, that provided a significant amount of liquidity to help tide them over.
The quantitative easing.
Yes. Well, we didn't do quantitative easing so much in Canada, but we do have emergency liquidity funds available at times of crisis, and those funds were heavily drawn upon by the banking system, and appropriately so, because that's what it's there for. But the finance department also bought a large number of illiquid mortgages from the banks that reliquified them at a time when they needed it the most. So let's not be in any doubt that the banks were able to sail through because they were so exquisitely well managed. They were so exquisitely conservative. There was a significant amount of assistance from the state that helped us. But the point I wanted to make was, sure, we didn't have to bail them out, right? Like the UK did and like US did. And I would say that stabilizing intervention is always profitable, right? And it was even for the US Treasury. But we didn't need to intervene in that way because we as consumers and taxpayers give the banks help every day.
You open up going through some of the daily transactions that we do, and those are the small ones, but a lot of small transactions add up to a lot of money. Give me a few examples and compare it as you do in the book to the Australians and the Brits, because I think that's insightful for people who will. I mean, it's that Canadian, reflex. Oh, no, we couldn't possibly do like the Americans do. But hey, let me get down to the United States as quick as I can for a holiday. So the Brits and the Australians have similar banking systems to us, but they pay far less. How are they able to do that? The banks are still profitable. I never hear that Barclays is going under, or Royal Bank of Scotland, or any of the, they're doing okay.
Well, let's talk about this. Let's talk about what happens here in Canada. The first thing to frame this, many Canadians still use paper checks to settle their transactions, right? And so every now and again, for whatever reason, you might bounce a check, i.e. you don't have enough in your account to cover the check that you've written. So if you do that, you'll get a charge of $48. Think about that for a second, $48. If you were to find yourself on the wrong side of that transaction in the UK or Australia, come anywhere from $2 to $5, maybe even nothing. So that's a huge difference. Just right.
$2 to $48.
No,
it's $2
to $48.
Yeah, that's what I'm saying. It's $2 in some of these places.
Right.
$48 here.
Right. And
thankfully, I haven't bounced the check in quite a while because I didn't know it was that high.
Right. So I was actually in the UK recently, and I walked past a bank machine in Piccadilly Circus Station in London, and above it, in broadly advertised, was free withdrawals. So if I go and take money out of another bank's bank machine here, I'm going to get hit with a fee of $150, just like that. Whereas in the UK, you won't pay anything for that. So and overall fees for a fee for a checking account can be minimal to zero in those countries. So here's the thing. After my book was published, I had an op-ed in the Globe and Mail outlining some of these costs. And on my LinkedIn account, I received a message from a member of the public that thanked me for outlining just how egregiously high these fees were and how arbitrarily they were applied. And he told me a sort of a almost distressing story about how he had to take over his father's financial affairs because his father was getting really too old to manage them. And he outlined $2,500 worth of charges that his bank had hit him with because he was bouncing checks. He wasn't keeping track of his bank balance. Every time he went into overdraft, he got hit with a fee. Then he got hit with overdraft interest charges, plus the fees on the bank of some account rather, of some $15 to $20 a time. And over a 2-year period, it was $2,500. Now, in 2019, the Financial Conduct Authority in the UK banned their banks from charging any of these fees on any of these transactions. Moreover, they gave the banks a mandate, or no, not a mandate, a requirement, a duty of care. Because if you can write an algorithm that can assign a charge every time someone's account is deteriorating, then you can have a signal that perhaps you should look at the details of why that cat or that person's financial affairs are deteriorating, and you need to go and find out why and see if you can help them. We do not do any of that here in Canada.
I can't imagine that happening at all. At the beginning, you were going through you put in very detailed terms the Interac system. And you mentioned free withdrawals earlier, but I just wanted to pull it up. You point out that most people don't know this. The Interac system is jointly owned by all the banks, and it makes a profit, and they all make a profit off of it with these 6 cents transactions that they'll charge us $1.50 for, or the merchant a fee for. But you point out the cash withdrawal, that if it's $1.50 on a $1,000 transaction, that's 0.15%. But you go down to a withdrawal fee of 3%, or sorry, a 7.5% if you're going at $20. So a young person going out to spend, some spending money, they're paying 7.5% to get $20.
Yeah. Yeah. It's shocking, isn't it, Brian?
It really is. I mean, that was one of the ones that really pissed me off.
Well, yeah. I mean, the whole payment system needs some examination. Now, the anecdote I was giving, or not so much an anecdote, I was illustrating the difference between having an open banking app on your phone where you could do your foreign exchange transaction in the blink of an eye at the lowest possible cost. And that requires an enhancement to our payment system here in Canada. And for some time, there's been a proposal to introduce an instantaneous settlement system here in Canada called real-time rail. Now, the Canadian payment system has been a thorn in the side of the federal government for over 40 years, as I outlined in the book. And there have been various attempts to loosen the bank's grip over that payment system because they use it as a sort of a castle wall and a moat to keep competition at bay. But every time the federal government attempts to open that up to more competition, somehow the banks reassert their control and dominance over it. So the Canadian payment, the CBA used to manage the payment system. Then it became the Canadian Payments Association. Then that was rebranded a few years ago to Payments Canada, when they were going to take responsibility for delivering real-time rail. And then they decided, well, we'll outsource that to Interac. And who owns Interac?
Yeah.
Right. So you get the story here, right? Like, you can't make this stuff up. I mean, and so anyway, real-time rail was supposed to have arrived, or the tracks to real-time rail, as it were should have been laid down by last year, and now nobody seems to know when it's coming. And it's not hyperbole to say we don't know when it's coming at all. So if we don't have instantaneous settlement, we don't have access to open banking. If we don't have access to open banking, we remain in the bottom 5 of 70 countries globally that's not making its mark in digital banking, which is pathetic because we have one of the highest rates of smartphone penetration in the world, and we are a highly digitally literate country. But we can't get there because we can't access it.
So going in this direction, the real-time rail, that would lower costs for merchants who are always talking about the high fees the banks put on them. That would lower costs for consumers. What's standing in the way of us adopting this? I mean, are there disruptors? At one point, PayPal was a disruptor for the banking system. It's kind of faded. I don't see as much use of that, although I was offered PayPal as an option to book a flight just recently. Are there tech disruptors out there that could push this along?
Yes, absolutely there are. Canada has already quite a well-developed fintech industry, but it's stalled. Neo, for example, the bank headquartered in Calgary, became the payments provider for Tim Hortons, for instance. So we are making some penetration, but the key point is that we still have to go through through Payments Canada, which is run by the banks, run for the banks, and there's only so much we can achieve without this instantaneous settlement system. So we're not getting the full benefit of the infrastructure that we've already been put in place because it's just sitting there on the periphery, and we're unable to leverage it to our full advantage. So imagine, that there's about 2% of GDP that's being funneled to bank shareholders that could be distributed to customers and a new nascent industry to create opportunity for a highly educated young population. So, the costs are more than just the cost to you and I as consumers. There are real negative network effects, as it were, for the economy as a whole because we refuse to modernize our system. And whether that's a combination of institutional obstructionism and bureaucratic inertia, I'm not really sure. But I am more than convinced that both of those issues is restraining our development.
We need to take a quick break, Andrew, but when we come back, I want to talk about opening up the banking system, busting it open with competition. Is that one of the answers? More in moments. Canada's banking system costs us a fortune, as you've been hearing, and if you're like me, you've just been getting angrier listening to Andrew talk. No offense, Andrew, but you're bringing us great information. It's just infuriating. Canadians don't like to like our airlines because we only have a couple of them. We don't like to like our cell phone providers because we only have a couple. That's how we like industry in Canada. It seems in banking that it's much more wide open because we have big six banks. We also have credit unions, which once upon a time charged lower fees. Now they charge the same as the banks. Last time I looked, they're nicer banks that still charge you through the nose. So what's the solution? Do we need to bust open competition? Because I'll tell you, I'm headed down to Florida to see my folks, and they bank with Royal Bank in Florida. They're allowed to go down and buy American banks, and TD, they own the eastern U.S. seaboard. Bank of Montreal just bought up a huge chunk of the California banking system while already having a big footprint in Chicagoland. We don't allow that here. Should we allow foreign banks, be it Barclays, be it Bank of America, to come into this country?
So this is a complicated issue. I think the answer to that is, no. My sense is, and having spoken to federal policymakers over the years, there's always been the concern that if you allow a U.S. bank of any heft that has the same capability as a Canadian bank, you're possibly or most likely looking at one of the big four money center banks, right? That would be Bank of America, Wells Fargo, Citibank, JP Morgan. And if you look at their balance sheet and their income statement, they look an awful like Canadian banks. They're large, they're much bigger than the Canadian banks, obviously. They're large, they have a degree of market power that equals that of the Canadian banks in their domestic market. And so it's not clear that if they were to come up here, they would do anything different than the Canadian banks, because that's what they're doing at home. There are about another 100 banks in the US that are small regional banks that don't have that market power, that do fund entrepreneurs and small businesses, and occasionally one or two of them goes under. But the US authorities are willing to accept that as a price for there at least to be some financing for local economies to entrepreneurs, because those businesses don't have the same market power. So the other issue you have with a market like Canada, which economists say is not contestable, you can't come up here and have a contest with them and hope to win. Those banks would have to come here, face high costs on the way in, would likely have to hire staff from the local bank, just because there are always differences between markets. they would be subject to what we call adverse selection, which is, who would be my new borrowers? Well, the people that the Canadian banks won't lend any money to, and they don't lend them any money for a reason, right? They may be high risks. So at the end of the day, this has never really been seen as a solution for this problem of oligopoly. However, the reason I put the fintechs on the table very early on is because now we do have a way to introduce competition to the banking system by what we call unbundling the bank, by allowing individual and small providers to come in and offer many of the different services that the banks offer at a competitive price, even though they don't have to build an entire bank to do that. And this is the reason why the banks want to slow walk the arrival of fintechs, and you can understand why. So it's digital technology, digital banking that will finally crack open this incontestability problem.
We've seen some attempts at that before with Tangerine. I forget what it used to be called, and now it's
ING Direct.
ING Direct. That was a much lower tech attempt at doing a similar thing. Changed to Tangerine, got bought up by Scotiabank, and now it's just Scotiabank's low-cost option. You had PC Financial, which has had some success. Is it just the new technology that's coming on board that makes it easier to do this unbundling?
Yes, it is. Right.
Does that help the small businesses? Because you spend a good time in the book talking about how in the United States, in Britain and elsewhere, banks will lend, and you just mentioned it, the smaller regional banks will lend to small businesses in the U.S., and small businesses here have an incredibly tough time getting loans. It's why people take out a line of credit on their home, or families pool together money to start a business. Because if you go to Royal Bank, if you go to Scotiabank, if you go to BMO, they're going to laugh at you.
Very much. I mean, I make the point in the book. Our banks are not in the business of risk, right? They're in the business of profits. So if you want to borrow money from a bank, you've got to show a good base of collateral, right? You have to show that if you don't honor your obligations, there's some security for them to seize. Now, banks have to be very careful about credit because they invest over very long periods of time, but we can withdraw our deposits tomorrow. And so that does make them very sensitive to loss. And we shouldn't bash the banks too heavily because we need them to be, to avoid that kind of risk. And they are expert at granting credit. So, we have to respect that to a degree. But
it helps our system run.
Yeah. But when you look at the spread between a small business loan and a large business loan is over 2.5%, whereas elsewhere in the world it's only about 0.5%. Right. So other countries are willing to put the resources into looking at the risk and adequately pricing the risk and distributing more credit. We don't, because our banks don't have to. They don't feel compelled to. They think it's too much risk. And there's no agency saying that this is a problem. Now, we do have two government agencies that have grown out of this problem, right? We have the Business Development Corporation and we have the Export Development Corporation, both specialized roles. But I don't know the BDC as well as I should, for full disclosure, but one has to think that, all of a sudden, if a government agency is granting credit and underwriting risk, then you've got to think, what's the risk that they're worried about? Is it they worried about the risk of loss, or are they worried about the reputational risk that comes from lending money and then losing money? Because politically, there will be a price to pay for that if it got too big. So we're stuck here, right? And there is no clear way to take this forward without some sort of reform.
I've just looked up the Bank of Canada's prime rate, 5.95% right now. So that means that for someone who is in a small business, they're more likely looking at just below 8.5% for a loan. That's a major hit.
Well, when inflation is falling back to 2%, yeah, the real rate of interest is very high.
Right. So the Conservatives have taken up this issue of banking fees being too high, but they are instinctively not big fans of going in for regulation. So, I mean, they'll do regulatory reform, but adding on new regulations is not generally their forte. How can they come about this? I think back to when Jim Flaherty was finance minister, and there was a demand that we needed more low-priced daily banking options. And Flaherty just said, okay, you as an industry have to come up with solutions that meet this. And if you don't, I'll impose them on you. And all of a sudden, the bank suddenly had all these programs for students and seniors, and you can, for this one low fee, do all of these things that used to cost you a very high fee. Is there something that, given that where the polls are at and where things appear to be headed, the Conservatives are most likely to win, where would you direct them or steer them?
I would first of all start where the UK did with open banking, which is bring all the banks into a room and say, okay, folks, we are going to launch open banking in 18 months. And you're going to do it whether you like it or not. And these are the rules. This is how it's going to get done. You can go over there and talk to the Fintech guys. And I'm going to assign an implementation trustee that will get this done on date X according to the principles that trustee decides upon once you've all had an opportunity to air your positions. That's
and what would that do for the average consumer?
It would open up. In the UK, there are 151 potential suppliers of financial products that anybody who has the open banking app on their phone can take advantage of. And that will bring a degree of price competition at a furious and fast pace that the banks will have no option but to respond to. And let's face it, incentives matter here. I have no doubt in my mind that the banks could respond positively to that once the incentive was put in front of them. So that's the first thing that the Conservatives could do, get tough. Secondly, cast your mind back to all the fee assignment that the UK government banned. So you can do exactly what Jim Flaherty did. Hey, I think you guys need to back off this stuff. Here's the list. I'm giving you the grace and favor to do so. But let there be no mistake. If you don't, I will make it happen.
Just lay down the law. Do it or I will.
Yeah, enough's enough, right? I mean, I think our banks are expensive, but they're safe. Okay. This is what we hear all the time, right? But the TD money laundering scandal was unfortunate. But I think that sort of drew the curtain a little bit on, well, are they as safe as we think they are, right? And the other issue is with the mail strike, right? With about I don't know what that number is, can't quite remember, but a quarter to a third of payments still being executed by a check. With a mail strike, there are all these checks stuck in mailbags in the sorting offices of the nation, and payments are not getting made. And so we've now introduced a degree of instability that our obsession with stability and safety has created. It's just the irony of ironies, right? So clearly, things have got to a pass where what we did yesterday is no longer good enough for today, let alone tomorrow.
I was owed 2 settlements that were rather large recently, and then the postal strike happened. I was terrified they would put the check in the mail. Thankfully, an electronic transfer, an e-transfer showed up, which, I mean, you also have problems with how we do e-transfers in this country, that we're not as advanced as elsewhere. I know about that.
No, we are not. No.
All right. Andrew, I want to thank you for your time today. It's been fantastic. The book is Fleeced, Canadians versus Their Banks. It's a short read. Get it in paperback format because throwing your Kindle or iPad at the wall will cost you a lot more. Thanks so much for your time, Andrew.
Brian, it's been a pleasure. Thank you very much for having me.
Full Comment is a post-media podcast. My name's Brian Lilly, your host. This episode was produced by Andre Prue with theme music by Bryce Hall. Kevin Libin is the executive producer. You can subscribe to Full Comment on Apple Podcasts, Spotify, YouTube, Amazon, wherever you get your podcasts. Make sure you leave us a rating or a review and tell your friends about us. Thanks for listening. Until next time, I'm Brian Lilly.